In this video, I'll talk about the S&P 500, the NASDAQ, and the Dow Jones. What is the good and bad expense ratios, market capitalization, and investing strategies for beginners. Hey, I'm Michael, and I've grown my net worth by $1 million in less than 4 years. And I'm going to show you finance hacks that you can implement today to take a step closer towards becoming a millionaire. The S&P is Standard & Poor, goes back to 1923, and is a leading index provider and data source of independent credit ratings, offering financial market intelligence to the United States market. It is the stock market index that tracks the performance of 500 large United States companies publicly available for trade. From the SP Global website, to be considered, the company has to meet 5 criteria. 1, the market capitalization has to be $9.8 billion or more. Also called the market cap, which is the stock market price times the number of shares. 2, based in the United States. 3, is highly liquid. 4, offer stocks to the public of at least 10% of the shares available for trade without restrictions. And 5, have positive reportings over the last quarter, plus the sum of the last 4 quarters having positive earnings. So historically, the S&P 500 over the last 100 years has been consistently performing at a 10% or better on average. So because of that, it is one of the best way for investors to get their feet wet is to invest in the S&P 500 indexes that replicates the same stock performance of the S&P 500. So there's several major financial institutions that offers these. So the 4 main ones that I'm aware of is the Vanguard 500 Index, the Fidelity 500 Index, the Charles Schwab S&P 500 Index Fund, and the T. Rowe Price Equity Index 500 Fund. So each of these here that I just listed are actually really great options because they replicate the S&P 500 and they have a very low expense ratio. They are actively managed by a portfolio manager. So the one I have and is my favorite is the Fidelity 500 Index. The biggest reason for that is because they have a very low expense ratio of 0.015%, which is an annual charge of 15 cents for every $1,000 invested in the Fidelity 500 Index. So all of these are actually very good. I would say that a good expense ratio is typically 0.5% or lower. You want your expense ratio typically to be lower because the higher the expense ratio means that you're paying someone else and that's eating away at your gains. You should definitely take a look at your investment portfolio. If you're paying 1% expense ratio, the high expense ratio is eating away at your earnings. I hope you like my video so far. Please like, subscribe, and press that bell notification. I post weekly contents about investing, money-saving tips, and real estate. As of January 2021, the top 10 companies on the S&P 500 are Apple, Microsoft, Amazon, Facebook, Tesla, Alphabet Class A, Alphabet Class C. Alphabet, by the way, is the parent company of Google. Berkshire Hathaway, Johnson & Johnson, and JP Morgan Chase. Let's talk a little bit here about some terms that you would typically hear. Large cap. Large cap is the $10 billion or more in valuation. Typically, this category is a stable and established company. Typically, household names and considered as a safe investment. Medium cap is the $2 billion to $10 billion of valuation. This category is typically companies that are becoming a national brand or in the midst of growth. Small cap is $250 million to $2 billion valuation, which this category typically has a high potential for growth and is generally riskier as it has less revenue streams. So let's talk about the NASDAQ. The NASDAQ 100 indexes weighed heavily more on technology. So the top 5 companies in NASDAQ makes up 40% of the portfolio. Note that the top 5 of the NASDAQ is also the top 5 of the S&P 500. However, for the S&P 500, it only makes up 13% of the portfolio and is much more diversified. So if you're trying to diversify, you would need to invest in the NASDAQ. Let's talk about Dow Jones. Dow Jones tracks the 30 large market cap companies in the United States and blue chip and publicly traded on the New York Stock Exchange. Blue chips are household brand names and generally considered as a stable and less risk. It is a market indicator of the economy and is the most watched indicator for the stock market. Let's jump back to the S&P 500. The measurement of the S&P 500 is called the market capitalization weighted index. So the market cap weighted index equals the share price times the number of shares available for trade. So to calculate the change in the S&P 500, you want to take the change in points for the day, divide by the total points before the change to come up with the percentage change. So for example, Friday, February 12th, the S&P 500 went up by 18.45 points. So if you take 18.45 points divided by the previous points before the change, and you multiply that by 100, you get 0.471%. So this represents a 0.471% interest for the day. This is a gain. This is a nice gain because it's only one day of trade, which is equivalent to 122% interest gain for the year. So to put this into perspective, a 10% interest annually is a gain of 1.5 points a day. So I hope you liked my video. I'll be talking more about the stock exchange and review of individual stocks that are on the rise. Please comment below and tell me about your experiences so far investing in the stock market. Thank you. Bye.